This is a multiple moving average oscillator developed. So it behaves very similarly to a multiple moving average on the price chart, except it does a couple of nifty things. It's an oscillator, which you can see here it fluctuates below and above the zero line. So it does a couple of nifty things, and I'll explain how that works. So what I'll do is I'll go through a few stock prices and show how it operates and how to use it, but also go through a couple of currencies as well, just to demonstrate how it works on the currencies. And secondly, I'll go through another strategy which was developed using the multiple indicator entry strategy, which we demonstrated previously. Then I'll go through some trading rules as a summary. So here first we're looking at Apple. As you can see here, like I do on my daily updates, I've got a weekly on the stock price. I've got a weekly as well as a daily chart. Now this is the indicator we're introducing. It's the multiple moving average oscillator. So the idea is, and I'm running a back test up here, so I'll cover that in a minute, but basically I'm running a back test throughout the whole of history. I'm not discriminating long or shorts based on the weekly. I'm taking every trade. So you can see there it's done quite nicely over the period. So again, this is going long only. I'm not showing you short back testing. I'm going through long only, and I'm going through the whole period without discriminating on weekly trends. So let me just zoom in for a minute and I'll explain how it should be used. So again, similar to what I do in my daily updates, when the weekly is showing a long position like it is back there from February 23, you can see there on the right side, that thin grey line, that's where you start taking long trades only. So this period here, you would have seen there where, at that point there, in February 22, again you can see there in February 22, that was short. So this indicator here summarises what it does here. So you would have avoided going long because the indicator was showing shorting positions only. So from here you wouldn't have taken those trades, even though this indicator says to take them. You would have started taking trades from that point on. You can see there from on the right side. Now what it also does, as I said, it's a multiple moving average, so it doesn't apply on the price chart. It applies as an indicator below the pane below. So what it can be used for, as you can see here, I've demonstrated a few divergences. So you can see here while the price is still rising, there's a couple of divergences going up there. And this is showing a bearish divergence on the price chart in those two spots. So the price is making new highs there on the price chart, but the moving average oscillator was showing lower highs. So basically what it's saying is avoid, either be cautious about going long, even though this is saying go long at that point. You could have traded that little spike there on the daily, okay? But again, be careful about going long too aggressively, because you can see there is a divergence happening. That was your first warning. The second warning was those lower highs there. So even though you're getting new highs on the price chart, again, you could have taken daily trades from that point. But again, it's just telling you to be careful. And from that point there, it took a dive, and you can see there the price also took a bit of a dive as well. Now, you can see there is still a low in terms of a high. You can still trade from that point. So again, be very careful about going long against divergence. So you can still trade from that point there, going long, and you would have had a nice little run so far. That's on the weekly, the divergence, but again, we look at the same thing for any potential divergence on the daily as well. So you can see there, again, this typically tracks along with the price. So the way you would track this is, you look at for any bearish divergence, you look at the highs here. So let's look at this one. There's a high there and a lower high there. High and lower high, so there's no divergence. Likewise, for any bullish divergence, we need to see any potential uptick. That was a little bit of a false break. They don't always work, by the way. Divergence don't always work. So there's no rule. That was pretty much, you can see there is a slightly higher low and a higher low, so you probably wouldn't have taken that trade, although there was a bit of a run there, but that was a pretty minimal. Again, lower lows, so there's no bullish signal there. Higher lows, no bullish signal. So I'm trying to find any bullish divergence and any bearish divergence, and there's none shown here, obviously. So divergence have got to be very obvious to spot. They can't be, you don't try to find a divergence if it doesn't exist, in other words. Okay, so again, bearish divergence happen with lower highs typically, and bullish divergence happen with higher lows typically, if they differ to the, in other words, if you get lower lows on the price and higher lows on the oscillator, that's where there's a potential bullish divergence. In this case, there's no, I couldn't spot any divergence on this chart. Let's go to a different stock. Let's look at Amazon. Again, you can see here for Amazon, there were higher highs on the price chart and lower highs on the oscillator on the weekly. So there would have been very minimal long positions to be taken there, if at all. So you might have had a bit of a false break on that one. You had no other divergence on the weekly. You can see here, zooming in, you had a slight bullish divergence on the price on the daily. And you can see there's pretty much a flat bottom on the price chart. So that would have been probably a double bottom, and that would have given you a nice little run there. Another bullish divergence on the oscillator here versus a bearish divergence on the price chart, and another little run there. So I'm just giving you some tips on how to spot divergence and how to potentially look out for any reversals. There's no bearish divergence on that one at the moment. And lastly, let's look at Caterpillar as a stock. So again, there, it's pretty long time frame, as you can see. So that was not a divergence because there was lower highs on the price chart and lower highs on the divergence there is on the oscillator as well. Except this one has higher highs on the price chart. You got to find the same spots where they start and finish. That's a lower high on the oscillator. So that would have been a nice area once it started turning down to either go short or get out of your positions. On the daily, you can see there bullish divergence, bearish divergence, you would have gone long. Bearish divergence, bullish divergence, and you would have closed out of your trade if you're trading in Caterpillar at this point. You would have, once that started turning down, especially if it started breaking down, remember on our daily updates we do on the daily videos, once it breaks below that channel, that's where you get out of the trade. Or if you're going short, go short at that point. And remember, and again I'll just zoom out for this one for Caterpillar as well, we only trade when the weekly is aligned in a long position. So for this one, for example, back there, that was in August 2014. You can see there, August 2014, short positions only, so no long positions. Okay, the oscillator is showing short positions. If I zoom out, that's going short only, so no long positions to be taken as per the back test. So that's all the other stocks. So let me just jump to some currencies for examples. So here we've got the examples using some currencies, and the difference here is I'm using the daily time frame for the trend, the major trend indicator. So we're going to take hourly trades on the daily. During the stock, I demonstrated just before. We trade on the daily, but we take the trends of the weekly time frame. Here we're using the daily time frame and trading on the hourly time frame. So again, using the same backtest method, we're going long only. I'm not applying the short positions here to demonstrate. But again, we can also reference the daily time frame for any divergence. You can see there are higher lows on the oscillator versus lower lows on the price chart, and that would have been a nice area to go long during that little peak spike in the price of the Aussie US. Another bullish divergence on the oscillator versus a bearish divergence on the price chart. Again, another area you could have gone long. Again, we're only trading when the weekly is going long, in line with the hourly as well. So only take long trades. So for example, back here, you would have taken long trades from that point on. So you would have taken little long trades there. The other thing to notice here as well on the hourly, we've also got divergence. You got a bearish divergence versus a bullish divergence on the price chart. You can see there very clearly it's broken down through our channel. Remember the channel we draw? And just to remind you, we draw a channel when the price breaks below the lowest candle, and that would probably be one of those. So the price breaks below that, and then we draw a Fibonacci between the recent low and the recent high, and you'll probably see it's broken down there. You would have had the initial target range, and it's hit that target range, and it looks like it's going to go probably even further. So that was a little successful divergence trade going short, if you're going short. And again, what we're doing here is going long only, and you would have gone long only during the periods where the hourly oscillator is going long, in line with the long positions on the daily time frame as well. That's the Aussie US. Let's look at the Euro British pound to demonstrate. And what we've got here is a few divergence there, a bullish divergence, you can see there, another bullish divergence there. There was a bearish divergence there. Price dropped off, but similar concept. Only go long. Again, this is the long program only. You could apply the short program in the same way with using the rules, and I'll explain the rules in a minute. But again, zooming in here, you can see here on the hourly time frame, long divergence, short divergence. You would have had a very small minimal gain. Long divergence, short divergence, and this is still in play, so hasn't actually executed. Mind you, if it doesn't break above the channel, I won't draw it in this case, but you can just picture a trend line going down there. If it doesn't break above that, then there's no need to enter long, even if this shows a bullish divergence. And lastly, I'll demonstrate gold. So again, the same principle. We trade only direction of the weekly. You can see there on gold, on the daily. On gold is a bullish divergence, bearish divergence, and you take trades going long only on the hourly. A bearish divergence, bullish divergence on the price chart, and you would have taken short trades from that point. And again, this is only going long on our hourly time frame. You can see there, I'm back testing here throughout the whole period, but you would have taken long trades only, in line with the weekly. What I'm doing now is demonstrating the same stocks, comparing that latest program, which is the multiple moving average oscillator. That's the back test here in blue, and I've got the indicator which I demonstrated in the last video down here with these little spikes. So remember that was posted on the 12th of June, the multiple indicators. So whenever the spike was, so what we did is we make sure 3 or more indicators lined up before taking any trades, and that's indicated by these spikes. So that blue line there is showing where 3 or more indicators have hit 3 or more, and that's where you take a trade. And that is demonstrated by the red back test here at the top here. Now what I'm showing you, why am I showing you that, is because this latest program, I want to demonstrate a couple of things. This latest program, you can see here more recently, again, they're both going long, no short positions. So this latest program, the oscillator program I just demonstrated, you can see there this one opened up positions back here, and it ran since around about July or September in 2021, and it kept those positions. It kept adding to those positions in terms of adding to Amazon, that is. And you can see there the profitability fell off, and it's currently sitting at the baseline is 100,000, so you've gained about 17,400. Whereas you can see there for the same period, you entered a few times multiple entries and exits. In other words, you haven't held on to the positions for a long period. Now, the reason I'm showing you this, if I zoom out, you can see there overall the profitability of the oscillator is generated 17,000 versus 4,400 for the multiple indicator strategy, that the previous video I posted, this strategy. So just to understand that you are generating more revenue, but you're also adding more positions to your, if you're not using the weekly as a trend indicator, you are adding more to your positions. So you've got to decide how much you're prepared to take in terms of a drawdown. So for example, here you can see there last week's program generated 4,487, and at that point there it started at 4,100. So you've generated about $300 in revenue, even though you had a bit of a drawdown there. And the drawdown, let me just draw a ruler so you can understand what the drawdown means. So from that point down to that lowest point, that was a 1.5% drop in revenue. Whereas here, first of all, you're in a position longer. So if we draw a ruler from there down to that lowest point, it's dropped by almost 3% in terms of revenue. Okay, and here we're trading $2,000 lots. Every time you enter a trade, you're entering $2,000 lots of share value. So I suppose what I'm saying is you've got to be prepared to take a hit if you get caught out and adding to your positions as per the strategy. And also don't forget on the daily, on the share stock trading, I'm entering, remember the previous video, if you reference that, we kept taking out profits at, I believe it was 3%, 3 to 5% profit taking, and letting it drop by 3 to 5% as well. So you don't add too many times. So you can see there, as the price drops, as the share price drops, you add to your positions. In other words, you wouldn't be adding as the price is going sideways. So that's Amazon. You can see their profitability is higher, but also you be prepared to take a higher impact to your drawdown. Apple, likewise. I'm just comparing the two strategies now. So again, if you're running both these back tests throughout the whole period, we're not discriminating with the weekly. The oscillator was generating for Apple 21,154 versus 3,837. So a big difference in profitability, but also just be mindful is more positions opened and closed and held and longer during the oscillator strategy. And that's why I'm demonstrating this multiple indicator strategy in my daily videos. I don't want to be exposing or showing traders that you can actually, you're going to be getting too many entries and exits. And I've been criticized for not gaining some trades where I should have been gaining some trades. But again, I'm trying to be conservative in my revenue, but also my drawdown impact. So I don't want to show in other words, I don't want to be showing, I can show, almost 10 times this, or even a lot higher income than that. But the trick is you want to be careful you don't, when your drawdown is impacted, you're not impacted severely. So I'm trying to be more conservative in my trading. And lastly, Caterpillar as a stock price. Comparing the two strategies. 19,900 versus 5,100, again in revenue. So again, if you want to be more conservative, take the previous video we demonstrated, and if you've got a bit more tolerance in terms of holding on and adding, you can see there, for example, there you've added more positions, but you've kept it for a shorter period, but also a smaller time frame, but also smaller revenue. Here you've kept it longer, you've added more positions. And you can see there are more positions added throughout the whole period. Here you've added individual smaller positions. So what I've got here is the same comparison, again using the daily and the hourly timeframes. And we're doing a back test on the hourly timeframes, going back to the whole period. So again, I'm comparing now the oscillator strategy, which I just demonstrated, against the multiple indicator strategy I tested and demonstrated in the previous video. And that's this one down here. So basically comparing that strategy versus this strategy. So again, you can see here for the Aussie US on the hourly time frame, since around August 2022, it's generated 28,900 in revenue. These are going long only, versus the multiple indicator strategy has generated 5,200 going long only. Now again, that's not factoring in going long only for when the weekly is showing, the daily time frame is showing long. This is back testing the whole period. So again, a pretty big difference in terms of the two, but notice also how many times you enter and hold individual trades using the oscillator strategy versus the multiple indicator strategy. Next, we'll quickly look at Euro British Pound. likewise, going back through the whole period, the oscillator strategy is currently in a bit of a drawdown. You can see there from that high, but so is the multiple indicator strategy. But notice how many contracts you've entered. You got 7 currently open for the oscillator indicator versus 2 for the multiple indicator. So you've got to consider these things when you're trading a strategy, using the strategy. So in this case, using this strategy, what I would do if I want to fine tune this is to add to the positions on a bigger drop of the price before adding to the positions. Whereas this one, you can see there, adds to the position when it breaks above 3 or more indicators, and it waits for another drop in price before adding another position down there somewhere at that point. So again, you can change the parameters on this if you apply your own rules and your own risk profile. And lastly, looking at gold in terms of profitability, going long only. Again, the oscillator strategy versus the multiple indicator strategy. This has generated 1,062 versus 162 on the multiple indicator strategy. But again, you can see the drawdown and where you would have held those positions versus a lot less and a shorter time frame. Again, this is trading throughout the whole period. To avoid these, you would trade only in the direction of the daily. So let me just quickly jump to now the trading rules. So these are the trading rules for the multiple moving average oscillator. So we use the 15 EMA, exponential moving average of the close of the price, and the EMA 60 of the close. So the moving average, multiple moving average oscillator 10 is combining the exponential moving average 10 with a calculation of short minus long. So basically taking the value of the EMA 15 and subtracting the value of EMA 60. The same calculation happens on both the multiple moving average oscillator 10 and 5. The only difference is this, let's call it this indicator, oscillator 10, has got an EMA value of 10 of that calculation, and the oscillator 5 has got the EMA value of 5 for the same calculation. So basically, this MMA oscillator 10 is the slower moving average, the red line, and the moving average oscillator 5 is the faster blue line. So basically, we go long when the oscillator 5 crosses over the oscillator 10, the blue over the red, and you close out the position when the oscillator falls below the blue falls below the red. The oscillator 5 falls below the oscillator 10. That's where you close out the position or go short. So hopefully that's been a benefit to you. Again, just to summarise a few things. Depends what your risk strategy is and what you prefer to trade. I've demonstrated both the stocks trading using the daily time frame in line with the weekly trend, and I've also demonstrated the currencies here using the hourly time frame, trading in a trend of the daily trend. Again, you need to understand your risk profile. Do you like trading long, short, or both? And you need to understand what your account risk management is. In other words, how far you're prepared to take drawdowns. Make sure, if you want to use stop losses, fine. I'm not saying you should not. I'm just giving you my personal opinion and my personal experience. Just make sure you understand your risk profile, and by all means, feel free to ask any questions for any clarification if something wasn't clear. I'm trying to put out as much information as I can to make trading a more profitable experience for you guys. And again, feel free to share the video or share it with anyone you may want to, the experience with anyone else you want to bring into the trading arena. Let me know what you think, and we'll speak to you in a future video. Thanks for watching.